Welcome to the Ellsworth Advisors Quarterly Update. I'm Kuennen. This is my partner Cameron Miele. And today we'd like to kind of share an economic update of what's happened in the economy over the last quarter, and then tie it in with how the markets have performed accordingly, and give you some thoughts on what we see coming ahead of us in the next quarter. Cam, why don't you kick it off with some economic numbers?
Sure. Thank you, Kelly. And good afternoon, everybody. Hope everybody out there is well. These are strange times. And I think you hear that in the news every day, whether you want to say new normal, strange times. We're really living in unprecedented times right now. And if you look at the economy overall, we're seeing some very good news. We're also seeing some very negative news. And that's creating a lot of uncertainty. As a general economic update, last week the Bureau of Labor Statistics released their unemployment report. And the good news is total non-farm payrolls rose by 4.8 million individuals in June. That took the unemployment rate to 11.1%. Most of our plan participants will remember in January and February, we were hovering around historical lows in the 3.5% unemployment rate. That number spiked to 14.7% in April as all of these closures came to fruition. The number dipped to 13.3% in May. And then now, obviously, we have 11.1% unemployment. So the 3-month trend is positive. People are getting back to work. The economy is opening up. Obviously, now we're hearing all this news about spikes in COVID. And so that begs the question is, are we now looking at a situation where states are going to be pausing? Bars and restaurants are going to be closing. Outdoor attractions that had opened are now going to be closing. So are we really going to see unemployment spike again? And I think that's certainly the concern. But the trend, at least for the past 3 months, is people are getting back to work. And that's great for the economy. That's great for individuals. It's great for mental health. The real fallout is going to come in the second quarter with the GDP number. So the Atlanta Fed has one of the most comprehensive models for predicting GDP. It's called GDP Now, and it's a model that updates basically instantaneously as new economic numbers come out. Producer Price Index, Supply Chain Management Report, currency fluctuations, monetary supply, you name it. As economic information comes out, the Fed updates their model. So what do they say about the second quarter? According to the Atlanta Fed and their GDP Now model, they're expecting the second quarter to drop at an annualized rate of 35.2%. That's something we have never seen before, a drop like that. That basically means 1/3 of GDP has been shuttered in the second quarter on an annualized rate.
Real quick on that, because if you never saw an explanation of how GDP works, so what that GDP is really the growth of the economy from the previous quarter to the next quarter times 4.
Right.
So 35%, that means basically GDP dropped 8-9% from the previous quarter.
Yep. Good.
So it's not as scary as it sounds.
It's not as scary as it sounds.
But it does suck.
But it does, yes. And so when we look at that number, 35.2% on an annualized basis, that's historically, we've never seen that before. And what's more interesting is because of all the volatility, good numbers coming out, bad numbers coming out, the Atlanta Fed's model actually hit a low of 53.8% on June 4th. So it shows you this is a crazy situation. There's going to be volatility, and it's obviously very fluid. What does this mean for the economy going forward is very interesting. So I'm going to read verbatim. I apologize. This is verbatim. This is a study that was published by Deloitte last week. According to Deloitte, the U.S. economy experienced a sharp decline as activity in a number of sectors shut down in March 2020. Some of the decline was apparent right away, but most will be felt in the second quarter, when GDP will fall by an unprecedented 35.2% on an annualized basis. The economy will recover in the third quarter, but the recovery will be offset by another decline in fourth quarter GDP and slow growth in the following 2 quarters as the disease proves harder to eradicate than some optimists expect. Recovery will not really get underway until the middle of 2021. Given the low base GDP, growth in 2022 to 2024 may be in the 7 to 8% range. Growth returns to pre-COVID levels by the end of 2023, with the economy finally reaching full employment by first quarter 2025. So obviously, as everybody's heard on the news, the ramifications from COVID-19 are going to be felt in this country for decades. whether it's the debt situation, the unemployment situation, the disruption to sectors, the change in sectors. Is Zoom meetings going to be the new reality? Are companies going to have call centers? Are we going to do large conferences anymore? We don't know. So, what this says to us is expect volatility. Expect volatility, focus on good core investments, and maintain ample liquidity. One thing I do want to say that is a counter to all this negative news is the savings rate. So according to the Bureau of Economic Analysis, the personal savings rate, which is savings to disposable income, jumped to 12.6% in March, then further increased to 32.2% in April, and declined back to 23.2% in May. Now this compares to a historical average of 7 to 8% personal savings. We as Americans like to spend. We're consumers. We're not great savers. But really what this says is that over the past 3 months of the COVID crisis, because people have not been going out, but not driving their cars, but not going to dinner, Americans have socked away $1 trillion in savings. And given our historical love of spending, I would think that $1 trillion probably comes back into the economy and can actually serve to prop up a lot of industries, prop up GDP. So that $1 trillion could be a significant factor in the economy and the economic vitality of the U.S. Over the next several quarters.
Absolutely. To kind of tie into some of this from an investment standpoint, the reality is, we had the big drop in March, and from an investment standpoint, which really relates to your 401k balances, the reality is the market's always forward-looking, and the market also operates on a relative basis. So we know we just had 2 really bad quarters, especially second quarter was horrible. Third quarter is going to be better, so that's going to show growth. After the third quarter, Deloitte's predicting that fourth quarter may be slightly worse than third quarter, and that makes sense in the kind of the slow restart that we see happening right now. So maybe fits and starts the next several quarters as we move forward, but a gradual recovery back to the economic strength that we saw earlier this year or last year. But the market moves on a different path. And you got to remember, the stock market is composed of companies, and those companies give you a market average. And the reality with companies is if things are bad for the company or things aren't working right, companies make changes. So it's always going to be an evolution, and companies' managements find ways to increase profitability, make changes to the businesses. So even though the economy may not be fully recovered, that doesn't mean the market can't advance forward, or specifically individual stocks or individual companies can't grow their balance sheets, can't grow their revenues, and grow. What we've seen so far this year from a market standpoint, the Dow Jones, which measures 30 industrial companies year to date, and it's often quoted, the Dow Jones year to date is down 9.55%. All the market data is from Y charts, just from an informational standpoint. So the Dow's down 9.55 year to date. For the month of June, it was up 1.69. At its depths, the Dow was down over 30% back in March. The S&P 500, which also measures U.S. stocks, but 500 of the largest publicly traded companies, weighted towards company size. A little different picture. Year to date, the S&P 500 is down 4.04%. Once again, it was off more than 30% in March, but it's recovered a little bit more quickly. And that's because some of the weighting and the way the stocks are weighted in the S&P, that index is driven a little bit more by some of the big name tech companies, Apple, Amazon, Google. So those companies aren't necessarily represented in the Dow Jones. June, 1.84%, so a decent month there. Obviously, a lot of the recovery happened in April and May. Really, May was big recovery month for the U.S. indexes. In the small cap arena, so small company, U.S. company stocks, year to date still down 13.61%. Good month last month, up 3.4. Small caps, they were hit even harder than large caps. They were down over 40%. In mid-March, but they've recovered nicely. On the international front, MSCI, the EAFA, which measures developed countries or first world nations, however you want to call it, year-to-date still down 12.59%. June up 3.22, so a good bounce in June. Emerging market stocks, year-to-date down 10.73. Big month there, was up in June 6.69%. So international still lagging the U.S., but starting to pick up a little bit of steam. I think probably realistically, Europe, Asia, probably from a timing standpoint, a little bit ahead of us from a pandemic standpoint. Mm-hmm. They felt it first. They're recovering before us, and I think we're seeing that play out a little bit in the numbers. In general, though, in your 401k plans, you want to stay diversified, but you also want to stay invested. Unless you're planning on retiring in the short term in the next couple of years, and if you are planning on retiring in the next couple of years, to have some dollars set aside that aren't associated with the stock market does make sense. It's be hard to justify having all your money in bonds or cash or the stable asset account of your 401k because you will get no growth there. There's really no yield, no interest to be had these days because interest rates are so low. And the reality, if you're in bonds, that's all you're in. If things continue to improve, one, you're not going to get any ongoing interest. You're not going to get a whole lot of ongoing interest. There's not much room for rates to go down, which will push bond prices up. And if interest rates do start to go up a little bit, your bond prices will go down. So, to have any kind of growth, you need to be exposed to the stock market. If you have a long period of time, 3, 4, 5 years plus, that's where you're going to get your best returns. The worst is probably behind us in the market. Kind of the easy part of the recovery is probably also behind us. We're going to kind of grind along, but the reality in the long term, the quality companies are going to be where you get your growth with your 401k, your dollar cost averaging in. The volatility can be your friend when you're dollar cost averaging, but the key is, one, be conscious of what your exposure is, but don't step away just because of what we've seen happen. And once again, the market's starting to look past the recovery period already, but we do have a long slog ahead of us. We have to expect volatility.
But the key is corporate retirement plans are put in place to provide decades of investing,
exactly,
to build real wealth that you can retire on. So if you do have multiple years before retirement, if you're closer to retirement, hopefully you're in target date funds that are naturally going to be less aggressive, move more into fixed income. If you're younger, you can afford to be more aggressive. But the way we look at it, the fund lineups that we put into our corporate retirement plans are funds that we feel very comfortable with, that own great companies. And when we look at owning great companies, for us that means generally, if a company is a great company and a fund owns great companies, that fund should be worth more in 5 years than it is today. It should be worth more in 10 years than it is today, 20 years and 30 years. So you want to stay invested. And to your point, with dollar cost averaging, if you can, and this is a personal something that every individual needs to figure out, how much can you put in your 401k? What are you comfortable with? What do you need, to take home to live on? But if you can max out your 401k year after year, you should be very happy. And if you're maxing it out over the course of a year, you're taking advantage of your dollar cost averaging. Individuals that were putting away, whenever you get your paycheck every 2 weeks, every week, but if you were putting away money in March when the market was down 30%, you got the advantage of the market being up 30% over the next 2 months. So maxing out, dollar cost averaging, don't run away from the market. If you do feel nervous, if you do want to talk, if you want us to kind of walk through our investment philosophy and what we're doing in your 401k plan, your 403b plan, or if you want to talk about any topics that might make you uncomfortable in your financial situation, reach out to us. We're here. We're happy to get on the phone. We're happy to do a Zoom. We're happy to tell you our thoughts. And I think sometimes just a reassuring voice on the other end of the phone can go a long way psychologically to making you feel better. But stay invested, stay in the market. We're going to keep slogging it out, and we'll get through this.
Absolutely. And we'll definitely help put things in. I really stress if you're uncomfortable with where you're at or you feel you want to make a big change, please reach out to myself, Cameron, Max, or Brett, and we'll walk you through, kind of put your 401k in the context of your bigger picture, and that'll make you feel better about making a change if a change is warranted, or holding tight and riding with what the original thoughts were when you set up your plan.
Absolutely.
Thank you. Have a great summer, and we'll be returning at the end of third quarter.
Thanks, everybody.
Thank you.